Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. A lot of new data points caught our attention in the first month of 2024. First, the employment index of the ISM Services Survey dropped sharply into negative territory, which is anything below 50 on this chart. This only happened 3 times previously in the 25-year history of the survey. All 3 coincided with recessions. Manufacturing employment has been weak for some time, but services still drive most of the U.S. economy. We've been waiting to see weakness in the services sector, and it appears to be arriving. Many components of the employment data we track are showing weakness. The quit rate of current workers, as well as the new hiring rate of companies, has returned to normal levels of a decade ago. We also are seeing individual states report higher unemployment rates year over year. However, the overall unemployment rate remains near a record low. As a reminder, the unemployment rate is one of the last metrics to move when an economy shifts into decline. Once the rate moves significantly higher, the recession has already started. At the start of this year, investors thought it was almost a certainty that the Federal Reserve would begin to cut rates in March. This never made sense to us. One of the reasons why is the tailwind from falling inflation in goods appears to be gone. Due to geopolitical conflicts in the Middle East, shipping routes are being changed for transporting goods across continents. As a result, there is a spike in cost for shipping containers. New headwinds like this will make it difficult for the Fed to reach its inflation target of 2% or below. Investors also concluded that a soft landing has been reached for the economy. We don't agree. There are still plenty of hurdles for the economy to overcome. And when the mainstream media is pushing the narrative of a soft landing as much as they are today, we are less inclined to believe that is how things will play out. The lack of concern about the economy is reflected in current stock valuations. This chart looks at the valuation of the stock market separated by sector. It evaluates how much variation in the valuations there are between stocks within the same sector. If there is a lot of difference, some stocks with a price-earnings ratio of 10 and others that are at 20 or 30, the bar will be high for that sector and above the 50 line. But if there's little difference among the stocks in a sector and they're all being valued about the same, it means investors see little controversy in that area and just want to broadly own anything in that industry. When the bars are low, like most of them are today, it's a difficult environment to select stocks because there is so little controversy. This confirms the complacency we see in high stock valuations today. We call it complacency because the actual economy continues to get worse. Every month, there are a series of regional manufacturing surveys that are reported in places like Dallas, Richmond, New York, Philadelphia, and Kansas City. These regional surveys reported significantly worse results in January. In some cases, like the Empire Survey in New York, it was one of the worst readings in its decades-long history. It's hard for us to believe in a soft landing when numbers like this are reported. As a reminder, investors that stuck to large cap indexes weighted by market cap were rewarded over the past year. 2023 was the second largest year of outperformance by the market cap index compared to its equal weighted counterpart in the past century. That doesn't mean the equal weight index has to outperform this year, but we do know the equal weight index has historically outperformed in the long run and that the financial markets move in cycles. With that said, the market cap index is outperforming again to start 2024. We see investors increasing their conviction that the Magnificent 7 stocks at the top of the market are the only place to be. But it was only a year and a half ago that tech was the worst performing sector. The market moves in cycles, and it's important not to get caught chasing a trend late in its life. The large cap indexes like the Dow Jones, S&P 500, and NASDAQ Composite are hitting new all-time highs. It makes investors believe that a new multi-year bull market has commenced. But under the surface, that's not the case. 9 of the 11 sectors of the market have not eclipsed their record highs of a couple years ago, and some are well below their peaks. Additionally, areas of the market that tend to be early leaders in a bull market, such as banks, retailers, and small cap stocks, are all about 20 to 30% below their record highs. Maybe this time is different and a new bull market can start without these sectors participating, but we prefer to stay balanced and not think that the risk of a negative reversal has diminished. Our last chart points out that valuation is going to matter more in this decade than during the zero interest rate era of the 2010s. This chart measures the annual outperformance of the cheapest 20% of stocks in the market when using metrics like free cash flow yield and price to earnings ratio. From the 1950s through the 2000s, owning cheap stocks typically led to outperformance of about 4 to 12% per year. Last decade was the relative worst, though, with only small outperformance. We believe the low interest rate environment led to greater speculation. It increased the odds of an investor being successful owning stocks that had nothing but a great story. So far in the 2020s, it appears valuation is a more important factor again. We are keeping that at the forefront of our process to mitigate downside during what we think will be an up and down decade for financial assets. We hope that provides a good update of what we're tracking in the financial markets. If you have any questions, please contact us. We like to provide the information we think is most valuable for investors. If you'd like to see more videos like this, please subscribe to our YouTube channel.